So we have a client, it's a father and son, and they're in a rather high-risk business. The business that they were in is very profitable, and they needed, based on their conversations with their CPA, they needed tax deductions. They had very strong cash flow, so it allowed us to set up a fairly rich plan, and the income of the owners was much greater than the average income of the rank and file employees. So in other words, if we took the father and son as highly compensated employees and their total income and compared it with the total income of all the employees who worked in the company, they had a much greater portion. It was upwards of $500,000 between just the two of them in wages versus about $250,000 with the rank and file. In this case, the father was much older than the son, and what we needed to do is we needed tax deductions. We needed to protect assets from creditors for the risk of the business. But as a third, a third motivation to this is we needed to secure some retirement income for the father outside of the transfer of the business. There are a lot of business owners out there who, while they're willing to sell their business to their children, they're not always willing to base the complete success of their retirement on how well the child does once they've vacated the business. This may resonate with more than one person out there. So in this case, what we did is we actually went in and set up a defined benefit plan. As a result, because of the age difference and the wage differences, about 80% of the total contributions made were able to go to the highly compensated group, the father and the son. And it was mainly because the father was much older than the rank and file group. The other thing that happened is because the father was much older than the son, of the $300,000 annual contribution, $240,000 of that went to this group, $200,000 of that went to the father each year, and $40,000 went to the son. And it all had to do with the plan design based on the age disparity. So at the end result was very efficient. Over a 5-year period, we were able to, on a very tax efficient manner, pull $1 million out of the company, completely tax deductible, which helped a tremendous amount in taxes. Set that aside in an account that absolutely could not be touched by creditors. A retirement account under ERISA law is one of the most secure places you can put money to protect it from creditors. The laws are very stringent in how you cannot attach to those assets. So what that does is that we sheltered those assets, and then the third piece of that is we pulled basically a lot of the retained earnings out of the company over that 5-year period, making it much easier for the father to transfer the business to the son. Instead of having to base his retirement income for the next 30 years on what the son could pay in an installment sale over the next couple of years, he was actually able to pull most of his retirement income from this retirement account that had already been set out, and it allowed him to give a much longer loan period with much less cash flow stress on the son to acquire the business from him. So at the end of the day, we solved 2 problems deliberately, and the third was just a nice benefit. Is we got a lot of tax deductions. We took a lot of money and protected it from creditors due to the high risk nature of the business, and we made the business much easier to be able to be transferred to the son.